Your favorite neutral strategy has a fatal flaw. A volatility spike wipes out months of gains in minutes. But this trade turns that exact weakness into your strongest edge. Most traders default to Iron Condors for range-bound markets, but they ignore the glass jaw of that strategy, negative Vega. If the market panics, you lose. The double calendar spread solves this. It takes the profit engine of a standard calendar, Time Decay, but splits the strike prices to create a massive, defensible profit tent that actually benefits when fear enters the market. Structuring this requires precision. We are combining a put calendar and a call calendar at different strikes, usually around the 20 to 25 delta on both sides. You sell the near-term options to collect theta and buy the longer-term options to hedge your exposure. This creates a wider break-even zone than a single calendar, fixing that strategy's main weakness, its dangerously narrow peak. But here is the twist that catches novices off guard. While this looks like a neutral trade, it is actually a volatility play in disguise. As we discussed in Phase 4 regarding term structure, back-month options react differently to volatility shocks. If implied volatility rises, the back-month options you own increase in value faster than the front-month options you sold. This creates a unique M-shaped payoff diagram. Your maximum profit occurs if the stock lands exactly on one of your short strikes at expiration. However, don't chase that perfect pin. The real goal here is to capture the sag in the middle of the tent. As long as the stock stays between your strikes and volatility doesn't crush, the combined theta decay from 4 legs accelerates rapidly. The trade-off? This strategy requires roughly double the capital of a single calendar and involves 4 legs of commission. Use this in low IV environments where you expect a chop or a slight rise in volatility. It is the sophisticated trader's answer to the Iron Condor. Master the Greeks, manage the risk, and stay trade-focused.